Welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I will be your host here for about the next 30 minutes here on Options Guide TV. Today's date is Wednesday, May 15th, 2024. The markets are rocking and rolling. As I mentioned on Monday's show, there is a lot of economic data that has hit the tape. And if you don't want to bother with knowing, was it good for inflation? Was it bad for inflation? If you look at the 10-year came down from about 4.6 all the way down to about 4.37. So the markets are happy about what they've heard about the economy so far. The probability of a rate cut has now increased a little bit, but still the timing is the big question. Chairman Powell came out and basically made the statement that the chance of a rate increase is just nil, and took that off the table. That helped the markets start this rally. We now have had, once again, decent job numbers, decent earnings, with a lot of the companies still showing a fairly strong consumer. We're seeing the inflation numbers going the right way so far this week that we've seen, and that propelled the market to an all-time high. The S&P 500 index right now is at 5283.76. And as we mentioned on the show on Monday, the all-time high was 5264.85. So we didn't even pause. And that was the one thing that we were kind of hoping on, that the market might pause and jump around that all-time high number. Now we'll see where the market closes today, but the economic data has been really is what propelled the market to this all-time high. And we actually adjusted our S&P 500 index trade and didn't do a weekly trade because of where the markets were at relative to that all-time high. The weekly trade we would have went out a little farther, because we would have been adding one more day on to our skip strike butterfly that we put on. So we're going to have to look at that trade. Ideally, you would have gotten out of the trade this morning when we hit the short strike of our skip strike butterfly. And at that point in time, you would have been down on the trade. You still have one entire day left, and we would have needed to hit the short strike tomorrow, basically, at this time. So we were off by a day on the trade. But the trade shouldn't have hurt us that bad, mainly because we did have 2 full days of time decay, and there was an opportunity to get out. It wasn't like the market just skyrocketed through the all-time high and you didn't have a chance to adjust that position. And the adjustment, to me, would have been to just close the trade, to just get out of the trade. So we've, after having weeks in a row of very solid trades that we put on, and some kind of odd trades too that we've done. Added some of the strategies that we don't do that often in the options playbook. And we looked at an NVIDIA trade, and we finally have NVIDIA move. It's up 3% today. It's trading at 942.76. We're going to look at our strategy in that trade, and then our Home Depot trade. We did a butterfly trade this week just around earnings, and really wanted to do a skip strike butterfly. And I should have just looked at selling an out of the money put spread, or call spread is the way that as opposed to the skip strike. But we did not do that. We targeted a range with a butterfly, and the market just went the wrong way. So we got hurt on that trade. So that trade's not even worth looking at. We needed Home Depot to go up, and Home Depot went down after their earnings report. HD, let's see where they're at right now, actually. They're trading at, give my thing a second. We're bouncing back a little bit here. Up 2% today at 374.67, but I think it's going to be a little bit of a day late, dollar short on that move. We do have until Friday, so there's a chip in a chair, to use a poker analogy, in that there was no reason to get out of the position because it was trading for next to nothing. But if we do get the move back towards the strikes, if this momentum stays strong in Home Depot, Maybe it could move a little bit off of Walmart's earnings. Now, Home Depot is obviously a different retailer than Walmart, but some good news from Walmart might be able to help them out a little bit. And they're going to be announcing earnings tomorrow. So we need a redemption trade because we've actually had 2 earnings trades in a row that didn't work out. They're speculative in nature. So we're going to look at a trade in Walmart and talk just a little bit about the pricing. Once again, a lot of things on Options Guide TV have to deal with understanding the underlying that you're trading. Different underlyings will have different dynamics, and a lot of it has to do just with the price of the underlying. The fact that Home Depot is a $347 stock, and you have pumped up implied volatilities, more than Walmart actually, and because of that, the butterflies are cheap. Walmart being a lower price stock, it makes it a little bit harder to do a trade like that. You can't go as wide on the wings, and that's a different dynamic that happens that hurts the trade. So there's no golden book of answers as to what strategy you'd want to do around earnings, and you don't necessarily even need to trade earnings, but you learn so much in the options trading world by paying attention to what happens after an earnings trade. And it can help you like build out strategies, S&P 500 index and the skip strike butterfly versus the put butterfly, and adjusting the put butterfly. Because if you understand the dynamics of it, it helps you know what your adjustment will be on that trade. All right, so let's start by looking at, well, I think I have Walmart up. So let's look at Walmart. Let's do the trade in Walmart. And as I mentioned, I'm not that excited about anything that a skip strike butterfly, anything that you can get fancy with on higher priced underlying stocks that have higher implied volatilities around earnings. Walmart, even with implied volatilities, and let's run out and look at the screen, and here we are. So in Walmart, we're looking at a $60 stock, and with implied volatilities around earnings, it's still at a 64 implied volatility. The historical vol is 22. The at the money straddle is $2.40. And that means that we're talking about a 4% move or so on a $60 stock. So the expected move means that we're buying the most at the money call and the most at the money put. And that is with the nearest term earnings. And once again, that means that we're going out to May 17th, which is on Friday. Walmart's going to announce tomorrow morning before the open. So if we were to put a trade on, and I would do it closer to the close, not necessarily right now, but I would do a little closer to the close. But this is when we tape Options Guide TV, is 11 o'clock Eastern time every Monday, Wednesday, and Friday. So I'm going to look at just a long call spread. I think with the way the markets are going, the way Home Depot reacted today after the good economic data, that if we got some solid numbers from Walmart and the retailers, Amazon had some decent numbers, that we could get a little bit of a pop-up. So we're going to do, once again, a low risk, not put a lot of cash into it, but we're going to do a long call spread. And we're going to give ourselves, I'm not going to straddle the market in Walmart. I want to be within the expected move. I want to make sure that the marketplace thinks that move can happen before that Friday expiration. So that means that if I'm doing a long call spread, I want my short strike to be within the price of the long straddle, which is $2.40. So remember, well, let me go back, and I always feel a need to redefine things, and because a lot of people won't necessarily take the time to explain it while they're talking about it on the television, is that if the expected move is $2.40, that means that all you're doing is saying, if you bought the most at the money call and you bought the most at the money put, you are drawing a line in the sand. And if you're trading that, you want it to go more than the cost of that long straddle. And if you are on the other side of it and you're selling it, trading it, I guess, would mean buying it, you want it to go less. So it's much like an over under on a football game, on a basketball game, with they're making lines in Vegas. How many points will be scored, the total points scored for the game? Do you think it's going to go over, or do you think it's going to go under that total? And Vegas will put out that number, or the sports books all around the world, and you either go over or you go under. This is the marketplace version of that. And hence, whenever you hear people say that Walmart is expected to make a 4% move, it's an extremely simple calculation. You're taking this number, the long straddle, and dividing it by the stock price and saying the marketplace is showing a 4% move. The one thing they don't ever say, though, is that they're announcing on a Thursday that move is relative to an all-day Thursday and an all-day Friday move, right? So it's much different than a company that announces after the close on Thursday, and then it's only Friday, or if they announce on a Monday and you're looking at the Friday options. So there are some nuances to it. But with that said, we're going to use the Friday options. So we're going to use the at the money straddle for that Friday expiration. And we are going to so if we take $60 and we add $240 to it, that would be that'd be $62.40. That's where the expected move is at. Now, and one standard deviation move is higher than that. And it would be somewhere, well, this is 67, it would be above 63. It's right around a 16 delta is what representative of a one standard deviation move. So it's probably it's between these two, somewhere in here, just a little bit more than 63. So the straddle, or the long call spread that we're going to look to do, it needs to get there. We need to trust the marketplace that this is what the potential move. If the news is good, good is relative, right? Because stocks can go down on good news. But if the market reacts positively, we want to make sure that we're within what the marketplace thinks the move could be. So we're going to buy the 60 strike call. Oops, and let's get rid of this. So this is going to be our paper trade. And we're hoping to get the last two back. We were on a string for quite some time. I think we had like 10 in a row that were profitable. And now we're had two losers, so let's hopefully get our money back. Even though we're looking at them on paper, that's kind of the way that we're approaching this. We're just trying to learn. But I want more upside potential than downside on this one. So we're going to pay 69 cents, which is the midpoint, and a very tight market, obviously, because of earnings. And Walmart's a fairly decent marketplace anyways. A lot of solid open interest over here on the option contracts. And we're going 2 points wide. We're going to pay 69 cents. Our maximum risk for the trade is going to be $69 plus any commissions and fees that you might pay. And your upside is going to be $1.31 on the trade. And we're hoping that we blow through the expected move or a one standard deviation move to the upside after their earnings announcement. And it's trading above 62. So it's very straightforward, easy long call spread, but the logic that's behind it is really what needs to be talked about. So you have to be bullish on Walmart. You have to get the direction right. It's just like the Home Depot trade, which is showing that if you don't get the direction right, you still can't win on the trade. On Home Depot, I really did want to do a skip strike butterfly, but I just couldn't get it done for a net credit at a reasonable prices. Now, never have that problem in Amazon, more of the high flyer stocks that have more volatility around their earnings, more implied volatility. It's a little easier to do those trades at a net credit to the account. But in this scenario on the Home Depot, I think I might pull that one up and take a peek at it. I didn't know that Home Depot had popped so much this morning. So where is our bottom strike on Home Depot? We're looking at, let me pull up the screenshot from the other day. 355. So if we get another 2% move to the upside, there's a chance. Let's look at it, because there was really no reason to try to get out after earnings. We paid $1 for it, and the options were basically nothing. But no, now we got something going on here, right? So 355 is the call option, and we did Christmas tree butterfly with the slanting part of the butterfly from 355 to 365. So we're at 32 cents on the 355. So there's something there. And I don't know if I'd want to salvage it, try to just get out. You're still looking at a 10% delta here of it reaching it. So we still got 2 full days. And then it was the May 17th, right? So let's sell that. And then we did 3 of these. And then we did 2 of these. Buy. So you could get 24 cents. You could save 24 cents on your $1 trade. That might be worth closing it out on this strong move, or wait for earnings, and maybe that would be enough to propel Home Depot all the way back up towards the long strike. 2% move is nothing to sneeze at today. It's saying right now that at the money straddle is trading for about $5, which makes sense. We're right around the 1 standard deviation move right there. All right, so I digress. Let's go back and look at our SPX today, and let's look at the chart. So I'm going to zoom in a little bit, just so that we can kind of see what happened. Here's what we were highlighting in the SPX. Just a simple little trend line that shows the breakout here. Had a solid move up to the 50-day moving average, kind of hung around there for a day, and then look at these strong candles all the way up. We did have a little bit of a sell-off, and then we came right here today, and so far, since we've broken through the gap up, I mean, I really expected the market to do a little dance, like 3 or 4 candles right within this range. But this is a real strong move, and have been bullish on the marketplace basically since this breakout. Now, in this instance, the market is solid. We need it to stay below this level, right around that 267 level, right in that range. But if you did not get out of that trade, we did a 15-point wide trade. Now the market has gone against you, and it's going to be hurt. 44-point move today, solid move in the S&P 500 index. And let's look and see where our trade is at. But I would have closed it out today with only 1 day remaining and it hitting our short strike. So let me pull up that trade. SPX was at 51, we'll call it 70, just round up. 51.70 is where the market was at. That actually was on the close yesterday. And so SPX here. So the market was at, there we go. $52.18, $52.64. There we go. $52.18 is where the market was at. $52.65, $52.80, and $53.10 are our strikes. Let's go set that up. So we have the May expiration. No, we did the 16th expiration. We did 1 day early. This is the Friday, the normal Friday expiration. We were on the 16th. We bought the 52.65 strike, sold the 52.80 strike, sold that twice. Then we skipped our strike and went all the way up to the 53.10 to add the skip strike to that. So now the trade is down 410. The market is at 52.91, which is 10 points above our short strike. We put the trade on for $1.15. And yesterday, by the way, I did go out and get a snapshot of the trade, and we looked at the market being at 51. It was at, with the market trading. Let me grab where the market was at. We saw this spread was trading at $1.40 for the day. $1.40. The market was at 52.46. 52.46. That's where it was at. And this was trading for 140 yesterday. So if we would have had the market just hang around that instead of just blowing through the all-time high, that's kind of what our goal was. And then this, if we wanted it to hang right at the 52.65 level, the market was, the all-time high was 52.64.85, and it didn't do that. So right now you'd be down $3 on the trade. I would get out of the trade, but I would have exited the trade at 52.80 this morning. And you did have that possibility to exit that trade. But where do we go to next? So if we zoom in on this area, just a solid move to the upside in the S&P 500 index. So it's hard not to be bullish on the markets, considering the Fed's kind of getting what they want from the economic data that has happened. The earnings are still solid. You still have the AI bump that is happening. Companies that talk about AI are doing well. Stocks like Google are up again today. And even though there are concerns with Google about the what AI might do to their dominance in the search area, Google had a conference and performed very well at the conference, and the stock is reacting accordingly. So it's hard to see what could drive the marketplace back down. A change in Fed policy, maybe, but I don't really see that happening. Chairman Powell has been out talking a lot and giving a lot of comments, a lot of insights as to where the Fed is at with all the media that he's actually been doing so far. And when he came out and kind of laid the possibility of not doing a rate cut by the year end, he basically made that nil, made that zero. If that was the case, then that's really what's driven the market higher. Okay, so that is our trade in the S&P 500 index. If we do have one comment. Staying in the SPX since it can be down 1% tomorrow. Could get out for break even. All right, Anthony. It could be down tomorrow, but that isn't so. We got the comment up there. So I'm staying in the SPX since it could be down 1% tomorrow, and we could get out for break even. That is very possible. But you're playing with fire when you get to the last day in the S&P 500 index on a skip strike butterfly. I normally, if we would have got out at, let's say 52.80, this might have been trading for about $2 and it would have been maybe $1 loss on the trade. Tomorrow, we're off by 1 day on this trade. Obviously, if we would have did the Wednesday expiration, would have been solid, but woulda, coulda, shoulda. Now you have extreme gamma going against you, and that if the market does go this direction, it's going to hurt bad. Once we get to the strike that we would have skipped, the 52.95, this is basically where our short spread is located, and that would really hurt in this scenario. So by doing that trade, or by just sticking around, you're really taking on a lot of risk, especially since it's already gone past the short strike. So my rule is, on the last day, if it's the last day before that trade and I hit the short strike, I'm going to get out of the trade. I may be profitable. It could be, depending on the dynamics of the trade, I may be profitable on that trade if it did hit that short strike with 1 day remaining. in this scenario with where the S&P 500 index is at, and looking at what we did on the what if calculator, it probably was trading for about $2, and I would have thought about getting out of the trade. The gamma is big. The gamma is really big right here. I don't like this range. If you kind of get a pullback towards the 5280 and some of this irrational exuberance goes away, but that's a lot of risk to take this overnight and to see what might happen in the morning. But gamma is going to get ugly from 52.95 all the way up to the 53.10. And that's just a fact on the trade. But we've always said on these skip strike butterflies, if you hit that short strike, you want to be out, because you're giving yourself so many different scenarios where you can win, right? I'm putting the skip strike butterfly on. We did it for $1. The logic was sound behind the trade. We did it for $1. We started it right where the long call that we bought, the 52.65, is right at an all-time high. You would think the market might just stall for a minute, but it did not. So the market is not doing what it should. I'm trying to think of a fun way to say that, but I'm not. I'm at a loss. So at 52.65, that is where the market would be hitting at an all-time high. Thought the market might hang out there for a minute or two. It did not. So if the market went down, the market slowly went up, or if the market went up a one standard deviation move, we all were solid. But now it's gone up more than that. So we had three different scenarios where we were fine. And now in this scenario, the worst case scenario happened. And so that's when I usually get out, because you have such a high probability trade of just breaking even on the trade or actually getting a profit on the trade, that when it goes hard against me and there's 1 day remaining and you got that gamma pushing on you, that's when I normally get out, is if it hits that short strike right there at that level with 1 day remaining. So my talking has saved some money. We're already down to $3.50 on the trade. You'd be down $2.50 on a 1x2x1 butterfly. All right. All right. That is the S&P 500 index. And where are we at? We're very close to time. Do you have any other questions? I do want to look at the NVIDIA trade, though. See where that is at, because we might want to get out of that trade also. 940 at this strike. We did the 900. Bought the 900. Expiration date is 5/24. 5/24. Bought the 900. This was a fun trade that we looked at going into earnings, which are going to be on the 22nd, and that is a Wednesday after the close. So we want to make sure we're out of this trade well before then, and we're going to buy these two. Let's clear this. Here we go. Sold this 950. Bought this, and then sold the 1025. Sell. So right now it's at a net credit of $1.40. We did it for $1.60. Still need to have that solid move. It hung around 900 forever. We're only up 2% so far. We'll probably look at this on Friday. We're up a few cents on this trade. We need this same type of move to the upside by Friday. 26 point move. Economic data is helping this out. The 10-year coming down is helping this out, trading at that level. So I don't mind staying in this trade, but I'm probably going to close it out on Friday no matter what. Obviously, if you were trading the portfolio actively, you might do it on Thursday. But Options Guy TV is going to be Friday. So we're up a little bit on the trade. We did it for $1.60 net credit to the account. We're pushing towards that 950 level. We really want to get on the upside of that, make these call options in the money. But here's the what if calculator. I'll throw it into the what if. So if you missed that episode, this is here's where the market was at when we did it. The market was down here. Now the market is here. It's stuck. It did the worst thing possible in NVIDIA, in that it just stayed at 900 for a week. It did nothing. It didn't go this direction to give you that small credit possibility, have the option contracts start to wither away. And now we're trading in this range. We still don't have a ton of risk. This is assuming that you did it for $1.24. We still anticipate an implied volatility increase, which are going to help our option contracts here. And we just really need this same type of move to be profitable and want to get up to this range where we got a decent amount of profitability. It looks like if you keep your eyes over here on this side, you can see that if we get within that range, we're up about $350 on the trade. A little bit of a limited risk, but you still want to try to be profitable on the trade. We got no movement in NVIDIA for the 1 week that we put it on. The implied volatility is going to help us here, and that's why we set up the trade this way, because we're going to have 2 at-the-money option contracts on that 950 strike. We want implied volatility to increase as that earnings approaches, and so far that has happened, and that's part of the reason why we're profitable on the trade. But we need another move today, like we had. We need another move before Friday, like we had today, a couple of percent move. NVIDIA can do it. Let's hope that we get it to the upside going into that earnings report. All right, we'll leave it there. All right, everyone. Well, thanks for hanging out. You can follow me and Options Guide TV either in the Tradier Hub. You can watch us on x.com and also on YouTube. If you're in YouTube, you can put in comments and ask questions, make it a very interactive show if you would like. And eventually we're going to be able to do that inside the Tradier Hub also. Please check out the Hub. A lot of great speakers in there. A big event coming. You're going to learn about it. Hang on. After the show, you're going to hear a little bit about the event with Tradier and the Chicago Board Option Exchange, or CBOE Global, now known as CBOE Global Markets. Thanks for coming, everyone. Click subscribe, ring the bell, hit a thumbs up if you're in x.com. That helps me out. And we'll see you this Friday for the next edition of Options Guide TV.
Calling all options and futures traders. The markets may be wild, but you don't have to be. Join the Tradier Options Summit sponsored by CBOE on May 22nd. Let's tame the volatility with expert tips and strategies on navigating volatile markets in 2024. I will be hosting this full-day virtual online event. Learn from the best. Industry leaders will share their insights, trade ideas, and strategies on navigating these volatile times. Plus, get a sneak peek into Tradier Futures, which will be launching soon. Sign up now to be part of the action. Reserve your free spot by registering at the link below. If you're part of our email list, stay tuned for your invitation and link to register. Also, remember to visit hub.tradier.com. Join the Tradier Hub for free for all your market insights, trading ideas, market news, and daily live shows with industry experts covering all aspects of the financial world. See you on the 22nd at 10 a.m. Eastern Time sharp.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc. All rights reserved. Member FINRA SIPC.